Good afternoon. This is Craig Sherman with Saturna Capital, and we continue our series of sustainable investing webinars. This topic actually has been a discussion within our investment team, and Levi's joining me, and it's really been a part of where we're seeing investment opportunities across a number of firms and a number of industries as we look to renewables and how it affects the auto industry and how it might affect batteries. And we thought of sort of cramming all that into one discussion. But I think what Levi's done here is really start with renewable electricity, and then we'll have subsequent webinars and subsequent information on other aspects of where the investment opportunities are. And, I really appreciate the work that Levi's done. I'll warn the audience that the charts are fairly detailed. So we'll try to go through them slowly because we're trying to cover a lot of ground. And I'll also, let everybody know that we do reference a little bit the study that was published last week by the Intergovernmental Policy on Panel on Climate Change, which is a 1,300-page document. Obviously a long read, but it talks about the science behind climate change and really well done. There's also a very nice 42-page policy summary. And some of the information that Levi will share really talks about what are the policy implications and what does that mean for the investment opportunities going forward. So I really appreciate the work that Levi's done to get to this point. You may have heard Levi on other webinars or seen some of the white papers that he's done. He's a senior investment analyst and a portfolio manager with us, but he's really taken the lead on some of the deep research that we do to identify investment opportunities across countries and regions and market segments and individual securities that we recommend. And towards the end of the conversation, we may talk a little bit about probably not specific securities, but where we see opportunities in the renewable space around utilities and other forms of electricity generation that's renewable. So welcome, Levi.
Yeah, thanks, Craig. I'm so happy to be here today. This is a subject that I find just absolutely fascinating and is one of my favorite parts of the job that I get to do. I wanted to set the scene a little bit today before we get into the investment opportunities and just discuss what's led us to this point today. Over the years, we've seen a really widespread interest in renewable energy, and the push towards a low carbon economy has slowly gathered steam over those years. But during the last 18 months, we've seen this critical mass develop. And as we dig into what sparked this increased interest, I find it's really valuable to just set a basis here. And what you see in this graph is a clear relationship between rising carbon dioxide levels and increased global temperatures. So Craig spoke to the Intergovernmental Panel on Climate Change, their recent report. It's a UN agency, top climate scientists from around the world. And this is their 6th assessment report. They've been working on these since around the early 90s. And the report stated this week, this has caught quite a bit of headlines, so I'll quote from it. It's a very direct statement of the situation we face, and that is, observed increases in greenhouse gas concentrations since 1750 are unequivocally caused by human activities. So it's this clear link between human activities, rising carbon dioxide levels, and temperatures increasing that has really kind of set the scene around the concerns folks have today of climate change and where it could be headed.
Yeah, and I think, Levi, the report, and just like you've done, the history of climate change and carbon dioxide release is now all the science is there. I mean, this is hundreds of scientists and studies just like you've shown, but really what are the future implications? And I think that's what we'll show later, looking backward, but also looking forward. What does this mean for the future?
Yeah, that's absolutely right. There's another graph that's similar to the one you see here. It dates back actually 800,000 years, just showing the tight band that global carbon dioxide levels have really held for that 800,000 years, and the hockey stick that's developed during this industrial revolution. So we've gone through periods of warming and ice ages that haven't marked the same degree of carbon dioxide levels that we're seeing today. And that's what's really led to the concerns that the IPCC is speaking to. There's a lot of ways to slice and dice this information around greenhouse gas emissions and what's led to the increases, but a couple trends are really clear. And that is, although the US has become more efficient over the past couple of decades with greenhouse gas consumption, there's no other major economy that even comes close to producing GHGs on the same level as the US. And the optimist in me sees that as an opportunity. In the US, renewables only account for 11% of total US energy consumption versus 35% in the EU. And so obviously with current technology, we can really help to lower these emissions levels, but it's a clear red flag that the US needs to get a hold of its greenhouse gas emissions.
And I think you do a nice job of pointing out the two important regions that when you're talking about countries and segments of the world, US and China. Now, you'll talk about both of those later on, because those are pretty important factors. And like you said, the US has shown improvement. There is a lot of room for improvement, and there are opportunities to create that improvement.
Exactly. And on the other end, you have China, which has rapidly developed. It's close to the same levels as Europe on a per capita basis. And of course, when you consider how many folks there are in China, what we've seen is this rapid ascension of emissions coming from China. And this is a story that should be familiar to the West as well. In many ways, the West fueled its economic growth through fossil fuels. And this is what we're seeing in China and India and other developing markets, is they're following the West's blueprint. And so, it's unsustainable what the U.S. consumer is using, but certainly if a much larger population were to consume at those same levels, we have a significant amount of greenhouse gas emissions that could further come online.
And even some of the smaller segments like Africa and Asia had fairly big increases coming from a very low base. So there may be opportunities there also.
Yeah, that's absolutely correct. And this is, I think, leads us into why electrification gets so much interest. For one, it allows for folks to maintain a standard of living or to increase their standards of living while still addressing greenhouse gas emissions. And in fact, while electricity and heat account for 30% of greenhouse gas emissions today, there's the potential for renewables and electrification to address up to 70% of global greenhouse gas emissions. And on this quest to raise electricity's profile, there's an expectation that renewable resources will capture 80% of the growth as electricity takes on these new markets. And that'll entail growing their share of the grid from around 20% globally to 40% by the end of this decade. In the developed market, one of the major contributions to increased or to lead electricity to increase its share of the energy, total energy use, is the electrification of transportation. And these are graphs according to the oil major BP. They provide an interesting energy outlook annually. So you can consider these as not necessarily the most optimistic of any organization. BP certainly has a big stake in energy, and maybe not as big of a stake in electricity, at least yet, certainly an area that they're looking at. But according to BP, they expect to see electricity's share of energy rise from around 20% today to 50% by 2050. And they actually acknowledge that we may well have actually already passed peak oil.
Yeah, we talked about this because as a firm, we tend to underweight energy. In the past we have, and that may change going forward as there's opportunities in renewables and other segments. You may see an overweight. And there are segments in the energy industry, and particularly like utilities, that tend to not fit into the mana screen because of their debt. And maybe we'll talk later about where we see opportunities in some of those spaces. But for the sustainable strategies we have that don't have the Islamic halal screens, you may see a larger weight in energy compared to what Saturna may have done in the past. So,
yeah, it's an interesting dynamic. We've seen there's for a long time been this name for large oil companies, the super majors, and increasingly there's a handful of utilities that are becoming called the renewable majors. So you can see that direct competition where energy is competing across its uses and sources, as opposed to maybe more where it used to be utilities compete against utilities and oil companies against oil companies. And so in order to reach net zero emissions by 2050, which has been this goal that's part of the Paris Accord, the growth in solar and wind will need to be very rapid. At the same time, unabated coal, which is coal that doesn't use carbon capture or storage, that's the CCUS you would see over there in the legend, is expected to be more or less phased out by 2040, with natural gas, which has often been promoted as a bridge, is expected to peak around late this decade and drop off rapidly there. We also see nuclear, hydrogen, other renewables such as biofuels see some growth, but it really pales in comparison to that of solar and wind and the growth that's expected and really needed from those energy sources moving forward.
Yeah, so just based on this chart, and is it going to take 20 years to get to that point? Hopefully it happens rapidly and sooner. And I think one of the reactions of the IPCC report is we need to move faster. But I think that this tells the story that the coal and traditional energy sectors will in fact shrink, and there will be opportunities in wind and solar, which is towards the end what we share some of the ideas that you have of investment opportunities.
Yeah, and I think that you were starting to allude to an interesting dynamic, and that's why now. Solar and wind aren't necessarily new technologies. They've been around for some time. We've been more or less alert that climate change is happening. There's certainly a greater consensus today than just about ever. So why now? What's spurred this along? What has allowed us to have this setup where renewables are coming online so fast? And I guess the economist in me says it's all about price. Price is the greatest signal to an economist. But my human instincts are supported by the findings that we've read this week from the IPCC report, say it's an existential threat. So, my instincts don't make for as nice a graph as these unsubsidized levelized costs of solar and wind do. And what you can really see here is those price levels coming down and falling well below their competition in nuclear, coal, or gas. And that's certainly helped with the build out of renewables, the fact that they are now cheaper than other conventional forms of energy.
And we talked a little bit yesterday is nuclear, which was part of what made Europe able to manage their carbon emission, really had a cost increase over the last few years, particularly when you had the tsunami that happened after the Japanese reactor implosion. So interesting how the dynamic does change, and that was the answer for Europe for many years, and now solar and wind look like they're better opportunities.
Yeah, it's been really interesting to see that price increase in nuclear, which is currently the most expensive major form of electricity, and a lot of that has come online after the challenges with permitting and whatnot due to the Fukushima disaster. And there's a lot of really interesting, very nascent work that's being done on nuclear energy, so I wouldn't say rule it out as it is a low carbon source, but right now the prices of wind and solar make them certainly much more attractive. Mm-hmm. Another important aspect that's been a clear catalyst for renewable energy development in the recent past couple of years is the sea change we've seen in countries that are making net zero pledges. So 2020 turned out to be a pivotal year. It seems that the threat of a pandemic may have finally helped awaken our senses of our mortality, and governments have seen the potential to address the economic disruption caused by the pandemic with spending on green infrastructure. And really, whatever the reason is, I think it's impressive and exciting to see the rise in global CO2 emissions that are covered by net zero pledges. In 2019, there was less than 20% of emissions that were covered. And as of Q1 2021 this year, over 70% are covered. Of course, a lot of these are pledges. Not all of them have been converted into law. And what will be really important is that that we make good on the pledges that have been made.
Yeah, and I think the UN report, the 42-page summary, it is just a policy summary, and you can start to see that clearly that'll be worked in. And I think you're going to see, more movement. And that policy summaries actually has some really clear outlines for what businesses and government entities need to do in order to respond to renewables and the climate change issues.
Yeah, that's a great point. In a lot of ways, there was an impetus for that report to be published because there's another meeting this year in Dublin that could be really fundamental as countries continue to make good on their Paris the Paris Agreement and show that they can really reach those goals by 2050, and 2030 has kind of stood out as this interim step. Another aspect of renewable energy that has, I think, been undershared but is starting to be appreciated is that although there's this politicized nature of renewables, especially in the US, the transition to a low carbon economy is likely at least to increase the number of jobs available to the global workforce. And these are generally skilled jobs. And this has made investing in renewables much more palatable across the political spectrum. Both parties here in the US really do support job growth. And of course, there's areas that are likely to lose jobs, and it's important that we don't turn our back on these. But when you look at it at a net level, the transition is exciting for job growth, and there's a lot of potential that I think both parties are starting to understand and appreciate.
Yeah, and I think this was a really useful slide because it starts to explain why more than just an energy company or utility, there are other industries like the technology industry that will support the growth here. And so you'll see the benefit, just like you're seeing semiconductors in the auto industry, you're going to see the benefit of other industries that feed into this growth. And that shows why the skill level is high in these areas because of the trade, the work, and the engineering that goes into this.
Yeah, that's a great point. The organization that put this graph out, the International Energy Agency, they came around after the oil crisis in the 70s. And so again, it's not necessarily a renewable think tank. I think it's a pretty unbiased view. And they expect overall employment in the energy sector to increase by 9 million by 2030. But overall growth, including that of the energy sector, but also in other kind of auxiliary industries to support it, overall job growth, they expect to be around 30 million new workers. So this is clean energy efficiency, low emissions technologies, and over half of that 30 million are expected to be highly skilled positions. So it is promising to see this, not just growth within energy, but in industries that support it. So on the previous slides, we've shown the expected energy increases, and those are really remarkable to consider. What's just as remarkable, I think, is the expected dollar value of investments. Annual investments in renewables are expected to more than triple and then hold these levels over the next 2 decades before slowing to a rate that's still more than double that of the annual average investment in renewables that occurred from 2016 to 2020. So this is a remarkable opportunity for investors, I think, is this substantial growth in renewables.
Yeah, and what we talked about is we're going to do a future webinar probably just about batteries and the storage, because that's an important part of the delivery mechanism, which is on the top graph.
Yeah, that's exactly right. And when you see the batteries here, that's just batteries for the grid and for storage of utilities. That doesn't actually include batteries for cars, which is an even more substantial segment. So batteries are another really exciting area that we're looking at. Craig explained we'll plan to do another presentation because it's worth it in and of themselves to really dig into the work that's being done on batteries and the opportunities there. What I'll also highlight on this slide is the infrastructure. There's been a lot of talk about infrastructure. We're seeing the bill in the U.S. Senate pass here to build out more infrastructure, and that's in terms of the grid and renewables and making renewable electricity. That's the next largest area for investment growth is infrastructure. And so along with renewable energy, what we see is the grid will need to be significantly increased to keep up with new energy sources and the challenges that are presented by more dynamic means of generating and using electricity that are associated with a non-dispatchable source that is renewable. So it's electricity that can't always be turned on and off. And so the grid has to become even more, as they'll call it, smart or hardened to deal with renewable electricity.
Yeah, it's interesting when you look at the EV charger piece of that. Like, we can't picture the day when EV chargers are everywhere, just like we have gas stations that are everywhere today. And that's exactly what will happen. But it's hard to see that when you only see a few EV chargers around today, you know?
Yeah, I mean, I think that's a great point because it might be easier, at least for me, I think it's easier to imagine just how drastic a change that would be to build out all those EV chargers. And you look at this, and it in and of itself is a great investment opportunity, but the size of building out all those chargers to match gas stations is still just a fraction of what's going to be needed to invest in the grid. So many industries will be disrupted, and it's almost hard to fathom the size of these investments. Taking it to a local level, within the U.S., solar capacity has actually lagged wind over the past decade or so. And you have to remember here, wind became economic first, and so received more investment initially. But solar capacity is expected to surpass wind by the early 2030s. Another organization or another thought leader in this area is Princeton University, and they've developed a roadmap to what it will take to become net zero in the US. And according to their research, they expect $830 billion on top of what's already spent will need to be invested in low carbon electricity sources. And that's between now and 2030. And this investment is really forecast to be dominated again by wind and solar. And so you can see wind and solar continue to emerge as these crucial energy sources for the transition to a low carbon economy. One thing I like to point out is we see a lot of the exponential growth in graphs and think, okay, that's a nice forecast. I know we're somewhat hardened to forecast, thinking that they're overly optimistic, and it's always good to question them. But what we've seen is forecasts, especially by the U.S. Energy Information Agency, but other organizations as well, have been continually adjusted upward. And there's a clear trend that expectations continue to increase year over year.
Yeah, and we talked about that. Like, historically, you'd look at a forecast and say, well, the reality will be different than that and probably less. But in this case, it always keeps going up, and I think a lot of the detail in the UN report really talks about not the 800,000 year history of what happened to climate change, but what the expectation is going forward. And some of that feeds into your data.
Yeah, that's exactly right. And the more we learn about, and not to be too doomsdayish, but the more we learn about climate change and how far it's progressed already, I think the more realization there is that this change isn't something that we can kick the can down the road on. It's something that needs to happen now. And as you can see in this forecast of wind's in very much the same story as what I just showed with solar. The exception is the 2017 forecast, which was quite high, and subsequent years were lower, but then saw revisions upward. And despite the downward revision from 2017 to 2018, 2017's forecast that looked optimistic in 2018 and 2019, that forecast actually undershot actual deployments in 2018, 2019, and 2020. So it's not just that forecasts are becoming more and more optimistic. There's a reason for it, and that's the build out of these technologies has surpassed forecasts historically. One of the more compelling depictions of this, I think, is the look at US offshore wind development. So in 2020, the Biden administration came out with a goal to reach 30 gigawatts of offshore wind by 2030. And the 2021 forecast that we see here, which was made well after that announcement date, shows that the US Energy Information Agency only expects 10 gigawatts of capacity by that date. So it's 1/3 the capacity, and despite the administration having this 2030 target. So by no means do I really think that these are optimistic forecasts. If you think about a large offshore wind project development, it only takes a handful of those developments to get to 10 gigawatts, and we've seen permitting for them really start to go through the federal agencies for offshore wind. And so I think that this again is a scenario where you see the forecast being on the more conservative side.
And back to your earlier slide where you talked about when the policy does change or the laws change or the administration makes it a priority, you see rapid change. And we saw that in Europe and we've seen that in other markets. And I think the US will just follow suit there. And like you said, this forecast will look pessimistic when we get 5 years out and we see how rapidly things can be implemented. And particularly when the economics are strong too.
Yeah, and that's a great point. And in some ways, the U.S. gets to be a free rider in here because Craig and I have talked about this before, but the Scandinavian countries and those along the Baltic have been really pushing their offshore wind capabilities, and the companies that have been building out those projects have become very adept at doing so. And the U.S. gets to benefit from essentially what's R&D. The trial and error of building a new project offshore will help, I think, grease the wheels, drive down prices for developing them here in the U.S. And so, yeah, I expect to see significant movement in this area as policy kind of opens up and eases for the permitting. So we've talked a lot about the need to build out wind and solar, and then just touched on building out the grid. And I think it's important to highlight how astounding this investment is, and that the fact that investments in electricity networks within the US are expected to triple by 2030. And here, much of that investment will be focused on transmission networks. If you think about how the grid is kind of currently built, the distribution networks that all tie from transmission networks to our houses, those are largely in place, and there's certainly some updating that could be done, but the transmission networks that bring and electricity from the source where it's generated to those distribution nodes are not necessarily the same. So where solar or wind assets are located are likely not where coal or gas or nuclear currently is located. And so that's why we see such a substantial investment needed in electricity transmission. And as you can see, this entails millions of kilometers globally that need to be built out just to bring renewables online. Another large chunk of this investment in the grid that I think is interesting to highlight is the investment in CO2 transportation. So this is developing pipelines or refurbishing current pipelines to be used to transport CO2 that's captured to a place where it can be stored. And this is another large investment opportunity. It's one that in my opinion will be hard to reach by 2030, just because the technology seems to lag that of electricity transmission lines or other renewables, but is something that is very much a part of any net zero plan. And so it's technology that will require investment and will be interesting to follow if the technology can keep up with this goal of $130 billion being spent by 2030.
Yeah, and you make a good point, because one of the things that we've been very aware of is we used to talk about climate risk and stranded assets as the starting point for a conversation. And now we see what the opportunity set is. As prices have come down, as policy has changed, as the science has been, shared globally, I think there is a lot of opportunity, and we've, changed a little bit of the conversation. Well, let's avoid where you might have stranded assets or risk related to climate change, and really where the investment opportunities. And I think the Princeton data is pretty telling in terms of where the investment opportunities would be.
Yeah, and I like these graphs. Even if you forget the numbers, it's a nice big square. It says, "Look at me." So, as Craig mentioned at the beginning of this presentation. There's a lot of data that I just spewed at you. There's a lot of graphs to digest. But if I had to distill all of the topics that we discussed here today, the few key takeaways I would focus on are: one, global investment in renewables and the grid is expected to more than double over the next decade. This is a massive amount of investment. The global GDP will actually benefit from the increased investment in energy. And of course, the reason why we're doing all of this is if we can make these investments, then global CO2 emissions are expected to drop by 40% by 2030. And again, this isn't something we can continue to kick the can down the road. So that's not optimistic to say global emissions are expected to drop 40%. We need to drop global emissions by 40%. So I think that this is all an exciting area to work in and to pay attention to. And I hope everyone took away a few interesting tidbits that'll help them consider this transition to a renewable and low carbon economy.
And thanks, Levi. And like we said, we'll do a subsequent discussion on renewables and probably do a deeper dive in the auto industry and maybe separate that discussion. But we'll also send copies of the slides to everyone. And we'll also send a link to the UN report and a copy of the policy summary, which I think are very valuable and useful follow-ups. And all of the sources that Levi had in there are all marked. If you have any questions about any of those sources, we'd be glad to provide that information. So thank you very much. We really appreciate the opportunity. Gus will be sending out the follow-on materials. And if you have any questions, please get a hold of Gus or myself. Thank you very much.
Please consider an investment's objectives, risks, charges, and expenses carefully before investing. To obtain this and other important information about the Saturna Sustainable Funds and a current prospectus or summary prospectus, please visit saturnasustainable.com or call toll-free 1-800-728-8762. Please read the prospectus or summary prospectus carefully before investing.